Hey, good afternoon, everyone. Thanks for coming to the webinar. And I'm really going to try to make this session as didactic as possible and provide you with as much information as I can about accurate ways to really what I consider to be the accurate way and appropriate way to trade the markets. All the information that I'm going to provide you with here is applicable to futures, Forex, and stocks. And just a little bit about myself. My name is Mark Sachs, and I'm with Rightline Trading. And a little bit about my background. I'm a graduate of the University of Pennsylvania, a former professor at Jefferson University in Philadelphia, PA. And I've been involved in the financial markets for close to 20 years. And I began trading the futures and Forex markets actually around 2004. And what provides me with the background to create an appropriate piece of software is really mathematical modeling. That's what I did my graduate work in, and that really is the genesis of the creation of Rightline Trading, and that is the creation of a series of independent variables placed into an equation and then optimized via mathematical modeling to provide us with software that really has the power to predict the future movement of any financial instrument. So the first thing I want to talk about briefly is, and I just want to go right to the stochastic oscillator and Renko bars, is really about the day trading industry as a whole. If we think about what's going on with us as commercial traders and us being the small guys in the market, we know that we can never make money trading against the institutional traders. They're the ones that create the trend, and they're the ones that we have to trade with. What we have to do is we have to trade against the other commercial traders, really the small guys, and we have to take money from them. Now, historically, 95% of all day traders wind up going broke. And I think if you break that down a little bit, I'd say about 85% go broke, and the other 10% just wind up running on a treadmill over a long period of time, sometimes for years. They make money and then they lose it back, and then they make money and they lose it back. And the issue is this: if each generation of day trader learned from the previous generation of day trader what was going wrong, then the statistics would evolve over time to provide the commercial day trader with an improving ability to make money. Yet that statistic, 95% failure rate, just remains. Now, no one's ever really determined it, but most people, the vast majority of day traders and swing traders, don't make money. And what I think is true is that over time, that number has not improved. And the reason this occurs is because each new generation of day trader takes the same information that the old generation of day trader that just busted out of the market used and uses it over again. And there's no evolution of trading methodology. We're stuck using the same indicators and the same system without anybody saying, okay, well, this doesn't work, let's discard it. This works, let's magnify it. I mean, there's no genesis on a scientific level for determining what works and what doesn't work. And everybody accepts what they're told is true without any mathematically sound scientific evidence to prove it. And that's why we consistently lose money. And this is what we have tried to change at Rightline. And I think that's the first lesson you need to learn in a didactic session, and that is that maybe a lot of the things that you've taken for granted as being accurate and will help you get precision entries just really doesn't work. And let me give you a quick example. And I'm going to give you a few quick examples of what day traders and swing traders just cling to and doesn't have any validity. And when you look at it mathematically, I mean, if you look at any science and you look at the compendium of information that's out there, and you can do a Lexis search, which is a world search in many, many languages on published papers looking at the mathematical validity of different indicators, there's nothing out there. I mean, nobody publishes anything of scientific validity to prove that what we're doing is valid and what we're doing actually works. And just to give you a quick example, there's a lot of software that uses a stochastic oscillator or any oscillator with Renko bars. And a lot of those software packages are really popular. And the reason they're popular is because not only do the developers, but also you as a commercial trader, when you do your due diligence, don't understand the formula for an oscillator. And in order for an oscillator to track out an accurate %K, it needs 4 numbers. It needs the high, the low, and the open of the close of each formation. So it doesn't matter whether you're trading time, tick, or range. When you use Renko bricks, there's really just an open and a close. So there's insufficient data on a standard Renko chart to drive an oscillator's formula. So if you look at the oscillator, and I'm going to come back to that, when you look at the oscillator on a range chart where there's a candle body, there's a high, low, open, and close, this is a real %K line. When you look on a Renko chart, all it's doing is simply tracing out price. There is no overbought, no oversold, and yet traders will cling to the stochastic when they're trading a standard Renko, and it provides them with absolutely no useful information. This is the kind of thing that we do and why there's such an enormous failure rate. Now, I just wanted to digress for a second and go back to a slide that I went past. There are 3 things that you must understand as a day trader in order to become profitable. And that is the sensitivity, specificity, and the positive predictive value of a trading entry. If you don't know those numbers, then you do not have any mathematical information regarding what percentage of trades are going to be winners and what percentage of trades are going to be losers based on the trading entry parameters. I mean, if you need indicator A to be here and indicator B to be here, or if you trade price action and market structure and you need this and this to be here, and that triggers an entry, if you don't understand what the sensitivity and specificity and positive predictive value are of those entries, then you have no idea whether your trading methodology is mathematically valid and is going to make you money. And the way that you don't want to find out is by trading real money, because that's not the kind of way you don't do trial and error by taking 25 different medicines to try to cure a rash when 24 of them may cause your skin to shed like a lizard. You have to know beforehand. Now, if you trade with a high degree of sensitivity, you want to get every single true positive move that the market makes. If the market breaks out, if the market moves 2 or 3 bars, whatever you determine to be a true positive move, you want to get every single one of those moves. Now, the price of trading with a lot of sensitivity is you pull in a lot of false This should be false positives. I don't want to retype it, but it's true positives over true positives plus false positives. And the false positive means that you get into a trade that doesn't follow through. And it comes right back at you and gives you a loser. Now, if you trade with a lot of sensitivity, you're going to get a lot of winners, but the price is going to be a lot of false positives, a lot of losers. Now, if you trade with a lot of specificity, what you want to do is you want to stay out of every trade that doesn't make your first target. You're looking for the true negatives. And a true negative is an unsuccessful trade. Now, the price of trading with a high degree of specificity is you're going to miss a lot of trades that do make it to your first target. So it's true negatives and should be true negatives over false negatives. And a false negative is a move that you make it assess will not make it to your first target and does. So it winds up being profitable. So if you trade with a lot of sensitivity, you're going to take a lot of trades. The price is going to be you're going to pull in losers. If you trade with a lot of specificity, you're going to stay out of a lot of trades to avoid losers. The price is going to be that a lot of winning trades are going to get past you. So what you have to do is you have to trade with a balance of sensitivity and specificity. And that is known as positive predictive value. And that's sensitivity over specificity times prevalence. Now, prevalence is, I'll teach you what prevalence is in a second. But if you don't understand the give and take between trying to get every good move, trying to stay out of every bad move, and understand the give and the give and take is sensitivity over specificity times prevalence, then you really don't understand how to day trade. And what you're looking for is to heavily weight specificity. The way to make money day trading is to avoid losers. If you take 2 winners every day and take a rare loser, you are going to be a very successful day trader, because the amount of money that you make is only limited by the number of contracts you trade. When you heavily weight towards trying to avoid losers, even at the cost of letting some winning trades get by you, you're going to start trading with the kind of confidence and the kind of positive predictive value that you want. And when you start moving towards a 75% or 80% positive predictive value, then you can start ramping up your contract number. Now, sensitivity over specificity is multiplied by prevalence, and I'll tell you what prevalence is. Prevalence is where in the market are you most likely to get a winning trade, and the answer is when the market is trending. So you want to create a sensitivity, a weight sensitivity and specificity, but make sure you only trade a trending market, because that's where the prevalence of a winning trade is going to be the highest. So it's very, of all the parameters that your software needs to define for you, trend is the single most important parameter. Because if you've got a perfect balance between sensitivity and specificity, and you don't trade in a trending market, the positive predictive value of your trades are going to get blown to pieces. That's really has to be your theology. It's got to be, the Bible of day trading. It has got to sit on top of these 3 values: sensitivity, specificity, and prevalence to give you a great positive predictive value, which is ultimately the number of trades you take that win versus the number of trades you take that lose. So let's just move on. Now, I think the oscillator, which is a bounded indicator, has to be the worst indicator ever created that everybody likes to use. It's a very, very common trading instrument, but nobody has ever looked at whether or not it creates a precision entry that increases the positive predictive value of your trade. And we can start out by saying that people trade it different ways. Now, I want to show you what not to do first, and then I'm going to show you what to do. This is going to be a little bit longer than an hour, but I think you're going to get information that you're just not going to see very many people talk about, because very few other people understand it. I mean, people are really quick to sell you Fibonacci and all these crazy things that have absolutely no validity, but they don't really understand price movement in a financial instrument, because it's really all based on mathematical modeling, not esoteric craziness. If you take an oscillator, when the market is overbought, you can trade it two different ways. Some people believe that the bulls are firmly in control, and they will trade every single broken pivot to the upside. They're not looking for a divergence signal. They're looking to continue to trade off of each upside broken pivot. The other group of traders are looking for a divergence signal. When the market gets overbought, they're looking to fade the market. So here you have two groups of commercial traders, each trading the oscillator in a completely different way. We looked at the positive predictive value of the of a trading entry with and without the oscillator, and found that it has no validity whatsoever. It's an elegant indicator. It really looks like it should work, but just like it looked like the world was flat 200 years ago, it just does nothing to help your trading entries, and therefore we have discarded it. We don't use an oscillator to trade. We use a different parameter that we have proven mathematically actually works. The other biggest finagle of all time is our Fibonacci levels. Every single generation of day trader just love it. And I think it's got like a sexiness to it, and it's got some kind of esoteric attraction. But let's look at the basis of Fibonacci. It was developed by a mathematician, I believe in the 1800s. I don't know if it was the 1700s or 1800s. And it doesn't make much difference, but it's because it's well before the financial markets were developed. Now, even though Elliott wave and Gann theory absolutely don't work, at least they were created to try to describe price movement in a market that actually did exist. Fibonacci was numbers, transformations are really elegant numbers. I mean, I've studied them extensively, but what they describe in nature is just some very esoteric stuff, like the number of edges of a snowflake, the number of ridges on a pine cone. What they do not describe is the interaction of any type of closed system. And what you have to look at is that the financial markets are closed systems, and they behave just like every other closed system. If you look at the law of thermodynamics, which you think is esoteric and not applicable to the markets, you're totally wrong. The pattern of randomness that closed systems develop is exactly translatable into the way the markets move. And Fibonacci levels absolutely predict nothing in terms of price movement. And we looked at 2 years of market replay data looking at Fibonacci retracements and extensions, and found that they don't work. And it does not matter whether you use one Fibonacci or clusters of Fibonacci. It is really a hoax. And I remember there was one guy, there's this lady called the Fibonacci Queen. And I don't know, maybe she's married to the Fibonacci King. But somebody posted a letter to her to ask if she ever made any money in the financial markets. And she refused to answer. Because the bottom line is, you'll never make a dime trading Fibonacci. If you use it, it's going to get in your way more often than it's going to help you. And it needs to be discarded as being totally irrelevant. And everybody that packages it in their software is simply because it looks sexy, it looks great, but it doesn't work. Trust me, it doesn't work. If it worked, we'd use it. It's really an easy indicator to deal with. And creating Fibonacci levels and Fibonacci confluences are very, very easy to do. But we don't use it because it won't help us. Now, in order for you to day trade, now we're going to get into a little bit of the nuts and bolts of what you do need to day trade. And this gets into some of the didactic information that is really the nuts and bolts of day trading. And this really are the didactic sessions that we do every Wednesday afternoon after we finish day trading in the room. You have to learn how to trade from the ground up. And from the ground up is first you have to learn how to trade price action. If you can't trade price action without any indicators at all, you will never be a successful day trader. You cannot rely on indicator analysis. No indicator confluence. If there was an indicator confluence that created a green dot for you to go long and a red dot for you to go short, it would have been found by mathematical modeling, and I don't know, the markets would fall apart. There just isn't one. Now there is a place for indicators, because I'm not a price action nihilist that says that indicators don't help you, because they do. But you have to learn how to trade price action. You have to look at this chart or a chart like it and determine where are the best places to trade. Now I've made it a little bit easier, because what we normally do is we don't even put, this is the 50, and this is our modified 15, which is a proprietary 15-period moving average. And normally we don't even start with that. We just trade price action alone. What this adds is market structure. So it gives you a little bit of an additional hint as to what you're looking for. And as a rule, if you're below the 50, we always go short. And if you're above the 50, you always go long. That's market structure. Another rule about market structure is we wait for the 15 to cross the 50 to take a short, and we wait for the 15 to cross the 50 to take a long. This will increase the positive predictive value of your trading entries. And that's what you want to do, remembering you only need 2 great entries a day on 3 or 4 contracts to easily clear between $1,200 and $1,300 a week on a $5,000 account. If you could make 20% per week for 52 weeks, you're going to make $52,000 on a $5,000 account. I mean, what other financial instrument can return that kind of money? I don't even know what the percentage is, but I don't know. It's probably like 5,000%, but I don't really know because I don't have my calculator. So we add price action and we add market structure and we create one rule. We go south when the 15's below the 50. We like the 50 to be red and the 15 to be red, and we go north or long when the 15's above the 50 and the 50's green and the 15 is green. Now, can those be mutable? Yes. But that, as a general rule, is really the way to trade. And I'm going to show you, I wrote right up here, and this is what I teach my students. There are 4 excellent trades on this chart. Point them out and describe them to me. And this takes a lot of work, but here they are. Boom. Now, you go long here. The 15 has crossed the 50. And what this is a break and retest of the 50. And the entry is an engulfing candle. This is trading price action and market structure. When you have a candle that engulfs the previous candle, there's a lot of buying enthusiasm here. You see there's an 8 range. This has 8 ticks of buying power in it. The bears did not allow the bulls, the bulls did not allow the bears to create a single tick of wick on this candle. This tells you that the likelihood of follow through to the upside is strong. The second trade is when the 50 and the 15 are both red. And this is a trade out of consolidation. And you can see when consolidation traps counter-trend traders, you always want to trade in the direction of the trend. That is another trading strategy that an enormous number of day traders are taught, and it's the quickest way to the poorhouse imaginable. Remember that a trend is created by the institutional guys. They create a trend. If you try to counter-trend trade against the institutional players, you're almost always going to lose. Almost always. So we look for consolidation to break out in the direction of the trend. And consolidation does. So that's trade number 2. The third is a multi-candle retracement and continuation short in a downtrend. We wait for the engulfing candle. Now the third is the most dangerous. It's a rollover, but this is a dark cloud cover, and the trend is down. So we're trading a roll to the downside, not into support, using market structure and price action. The 3 key candle formations are candles that engulf, and that's where the candle body equals the high or low of the previous, and a dark cloud cover, which is just a tick or two short of an engulfing candle. On a short trade, it penetrates at least half of the candle body of the previous candle. On a long trade, it's a piercing candle that pierces at least 1/2 the candle body of the previous candle to the upside. It's a lot of information. It takes a while to digest it all, but these are the kind of entries you want to take to increase the predictive value of your entries. And here's another one. Find 3 trades on this chart and describe. And this is a little bit easier. And if we roll here, there they are. It's a single candle retracement and continuation. Another single candle retracement and continuation, and these are cake. Because the 50 green, the 15 green, a pullback to support, and continuation. This is the power of trading with price action and market structure. Here is our multi-candle retracement. Now, I can show you something. I don't want to get too complicated. I'm going to show you why this is an awesome entry. And let me see if I can do this. Hang on one second. I'm going to try to modify this slide because I want to show you something. This is really important to see. Hang on one sec. I'm going to draw on it right now, actually. And when you see it, it's going to pop out at you. I'm going to say, my God, how can I ever see that? But I'm telling you, with a little bit of time, you will. Now, let me go back to this one. Go back here. Here's the slide I just drew. If you look, this is a falling channel. Every pivot gives you a lower high and a lower low. So when you take this trade, you're taking this out of a falling channel. Now, you may think this is hard to spot, but I'm telling you, with a little bit of chart time, you will be able to see it. So when you come back to resistance of the falling 50, you're actually also coming back to the resistance of a falling channel. So those falling channels are, remember, we only trade a falling channel into a short trend, and we only trade a rising channel into a long trend. And we're not trading with any indicators. We're just trading with price action and market structure. And if you learn this kind of information, you will become a profitable day trader. The question is do you want to take this entry? It's a multi-candle retracement, which are dangerous. But if you see that it's coming out of a falling channel created by this pivot, this pivot, this pivot, and now this pivot, you're in. And remember, this is an engulfing candle. So it just adds more fuel to the fire. This is a trade on the E-mini, and it's a huge trade. Now, the 50 is not red, but remember, you have to take into assessment with a lot of screen time, you've got the 15 heading down with an enormously high slope. And that overrides. In general, we want the 15 and the 50 to be green and the 15 and the 50 to be red. But if you want to get some of these trades, you have to give some of this a little bit of leeway. The key, though, is, and the one parameter that when I trade in the live trading room is I will not take a short trade until that 15 has crossed the 50 to the downside. I will not take a long trade until my 15 has crossed the 50 to the upside. And that's something I will not let go past me. And there's the trades. Single candle, multi-candle with a C engulfing, but I just added to the additional information that you're trading a falling channel into a downtrend. Right? Now you got two excellent long trades. Now these should be a little more obvious. And they're right here. This is a continuation out of consolidation. And I'm actually going to draw on this chart for you and make it a little more informative. Hang on one second, and let me do my drawing. Hold on one sec. Okay, I got it right here. Let me just draw some lines in here. Let me put that here. Let me put that here. Because I want to show you what's really going on and why you're killing here all the other commercial traders. And these are the people that you want to take money from. Do you see that what this is a period of consolidation? The candle bodies are very narrow. Now, we have a consolidation indicator, but I want you to be able to read consolidation first without the indicator. I want you to see a single candle retracement before we put the indicator in to give you the entry. Because I want you to be able to trade market structure and price action first. Now, what's happening here? And I'm going to show you what's happening. The dummies, or the ones that have been taught to trade in a counter-trend direction, are calling a high. Whoops. They're saying that in this particular case, bonds are not going any higher. So they have gone short. But we know that we're not going to take a short trade above the 50. And we know that they're counter-trend trading. Because we know that the institutional traders have created this long trend. And what happens to them? What they always do. We take the trade out of consolidation in the direction of the trend. They get stopped out. And when they get stopped out, they help push our trade in our direction. They've sold their contracts, and they have to buy them back to cover up, to cover their positions, and they help push this trade in the direction that we want it to go. And that's what happens in a single candle. And what happens here when these counter-trend traders are caught right here? This is what we have to capitalize on. And it's really unfortunate, but we have to capitalize on these traders. Now, let me tell you something. There's no institutional trader in this short candle. Because if the institutions were short here, they would shoot this market in the other direction. These are just commercial traders like us deciding based on an oscillator divergence or MACD divergence, whatever they're trading, that bonds has hit a high and they're going to take a reversal. What do? We take a piercing candle in the direction of the trade, and when we stop these all out, all these traders, It helps propel the trade in the direction of the trend. That's what we have to leverage. And we have to pull ourselves out of this group of traders because they're the ones that are giving us their money. What I want to tell you, in addition, now we're going to go on to a little bit of indicator assessment. I wish I could do more on price action and market structure because it really, really is. It's an awesome, fun topic. And when you master it, everything just pops out in your face. And you begin to see amazing trades. And then you look to the indicators to affirm the trade. But the trade is based on market structure and price action, not based on some confluence of indicators. That's the key. The linchpin of trading is a price action market structure setup with indicator confirmation. But the indicators have to be really good. So what's the predictive value of any indicator that assimilates data from your trading chart only? And it's 0. Because all they're doing is telling you where the market has been and not where the market's going. So if your indicators are simply tracing out, no matter what indicator you're using, that's why fibs don't work, because they're based on where the market has been. They're trying to predict what it's going to do in the future, but it's not possible. I'll show you what does predict what's going to happen in the future. And that is this indicator that we use. This is called background. This is called bias. And what this is doing is it totally ignores price on the chart. What it's doing is it's looking at the direction of price on the 2 higher time frames. Now on a 5 range, it's looking at the price movement on the 8 and the 13. So if price on the 8 and the 13 are moving to the downside, defined by in this way, the 15 is red and heading down, the 50 is red and heading down, and to get this color, all support to the downside has to be broken on the 2 higher time frames. Now you can look at those time frames on your own without this indicator. You can simply set up a whole array of charts for crude, watch the 8, watch the 13, watch when support's broken and everything's heading down, or you just look at background bias here. It's going to read it for you. Now, it sets for you the direction that price is going to move almost always on your trading chart. So if you're also below the 50 and the 15's below the 50, you're set up for a great short. All you need to do is find an entry. This does not give you an entry. It simply gives you the direction you want to trade. The other indicator that we rely heavily on is our quant analysis indicator. And the quant analysis indicator, again, totally ignores price on the trading chart. We don't care what price is doing on the trading chart when we use indicator analysis. What this is looking at is correlative markets, which I believe are key. They are the accurate assessment of money flow. Now, we know that when bonds go up, certain other markets also go up, and certain other markets go down. If you look at any financial instrument this way, the institutional traders have, for the most part, a fixed amount of money on any given day. Yeah, there's some money inflow and some money outflow, but for all intents and purposes, they're trading a fixed amount of money. And all they do in the course of the day is watch the news, watch technical analysis, watch their algorithms and their high-frequency trading computers, and they simply rotate money through different asset classes. So if risk is off and they don't want to trade high-risk instruments like stocks, they're going to rotate that money into low-risk instruments like bonds, low-risk instruments like notes, into lower-risk instruments like currencies, into other potentially low-risk instruments like precious metals. And these are the correlative markets that we're tracking. And it took us months because every single instrument has to have its own set of quant lines because the correlative markets are different. And a market has to correlate with a coefficient of 0.7 or greater to make it into this line. So 70% of the time or greater it has to move in the same direction or the counter-trend direction as bonds to be in this line. And each line has 3 markets. So for bonds, there's 6 correlative markets. And when they're green, it tells you that money is flowing into bonds in its correlative markets and out of the correlative markets in which money is flowing out of into bonds. So the fact that bonds are rising when you have dual green quants is not an accident. And the lines aren't green because price is rising. Price is rising because the lines are green. And what this is known as is a true independent variable. If any indicator requires price on your trading chart to be a participant in its assessment, it is no longer an independent variable. And you don't want to trade with dependent variables. They can't go into an equation to optimize if they're not totally independent of price movement on your trading chart. That's a mathematical axiom. Now take a look at what happens here when the correlative markets are just moving in disarray. Money is flowing in or out, and look what happens to price on your trading chart. It becomes chaotic. And I want you, and if you only take away this lesson from today, understand that the financial markets are like every other closed system in nature. They tend to move in maximum randomness unless there's the application of something special. If you have a kid and you look at his room always gets messier and messier and messier. And his room is a closed system. And if you look at any closed system in nature, it tends to move towards maximum randomness. What needs to be applied to your son's room is energy, which is you have to go in there or he has to pick up all his clothes. In nature, you have to apply pure energy. In the markets, you have to apply money. And the big financial institutions have to go to work and create this kind of asset class rotation to create order out of chaos. So only during the participation of the financial of the big institutional guys do we want to trade. We don't want to trade. Remember how important I said that prevalence was, and prevalence only occurs in a trending market? Well, this helps define trend. Background bias tells the only way you're going to get 3 time frames moving in the same direction is with the application of institutional money. The only way you're going to get all of these correlative markets aligned to give you dual greens is with the application of institutional money, and that's when we want to trade. Now, the reason we call it the quant analysis indicator is each market is quantitatively weighted in each line based upon its correlation coefficient. If it's 0.9, it's weighted high, quantitatively higher. If it's 0.7, it's weighted quantitatively lower. If it's 0.6, it's not included in the line. Now, this is market profile. I'm not really going to get into that because really what I want to do now is I want to move to our trading chart and show how we trade. And I'll show you today's trades, and I'll show you as many trades as you like, actually. Now, we make money in the trading room almost every day. I can take out my phone number, and let me show you our first trade. We took 3 trades today on the E-mini, and we made $450. It's right here. The first trade I took was I noticed 3 things going on. First of all, I noticed I had a great falling channel. And I'm below the 50. The 15's below the 50. So I know I want to take a short trade, and I know I got a nice falling channel to trade out of. So my first trade was right here. We had broken support of the modified 15. The first line, there's 9 correlative markets on the E-mini. The first line is the most important. We call it the major quant. The second line is the minor quant. That one has the smallest power. Intermediate quant is the lower line. But I'll trade with that major quant, the first line red, along with the second line red, because in my head, I've got enough correlative markets going in my direction to take the trade. And market structure-wise, the only reason I look down here is I've got a great entry out of a falling channel that's also a nice retracement back to resistance. And it only went 4 ticks and gave us a first target, and we made $75. But then it came back again to the resistance of the falling channel and the modified 15, and again, now remember, this is a fractal indicator. At the time I took this trade, all 3 quant lines were red. Now, if you go down here, this is the multi-time frame assessment. The top line is momentum, and the bottom line is order flow. And this is really a full house. You've got all 3 quant lines, multi-time frame assessment, and the time frame that's not assessed here is your trading chart. I'll show you the input on the indicator. Remember, we never care. It's a 21 range is put in here. What this is assessing is the direction of momentum and order flow on your 8, your 13, and your 21. 3 higher time frames. We don't care what it is on your trading chart. And we got 10 ticks, we made $237.50. Then I took a trade at a consolidation. And I told you how powerful consolidation is. Now, you'll notice here I had background bias was pink. I had all these guys counter-trend trading. Now, why in heaven's name would anybody go long here is beyond me. But here you got 2 long candles. And if you'll notice, the software gave us the entry. Now, the software entry was here. And look at this trade. I took the trade earlier because I saw the falling channel, which continues here, and I took it at a consolidation earlier. Now, it stuttered us out on this wick. We only have a 5-tick trailer, so we only made 9, and we made $137.50 on 2 contracts. This is on 4, and this was on 4. So on 10 contracts, we made $450, and we were done. End of day, end of story. And every time I made sure the quants were in my favor, I made sure that order flow and momentum were in my favor, multi-time frame assessment. But the key is I made sure that market structure, that was the key to my entry. I don't even look down until I see that I have an appropriate entry based on market structure and price action. That's how you make money in the market. Now, there's a lot of guys in the room trading the E-mini on 20 and 30 contracts, and they make an enormous amount of money because these quant lines are golden. The background bias tells you the direction of the 2 higher time frames. Order flow and momentum is assessed on 3 higher time frames, And we don't make any assessment on indicator analysis based on our trading chart because we don't care. That's not an independent assessment. Independent variables are ones that don't require the assessment of price on your trading chart. Now, this is a volume hammer, and I want you to understand something else too, which is extremely important, and that is most volume indicators simply tell you how much volume accumulates under a candle. And that's useless because there's two independent variables going into this assessment to create one independent variable. The two independent variables are one, rate of candle formation, and rate of contracts crossing. So let's say that a candle just sits here because the power of the bulls and the power of the bears is equal. And it just sits here for a long time. Remember, we're trading a range candle, not a tick and not a time chart. Well, you're going to get a big volume spike. But the volume spike is useless as an assessment of a big huge institutional participation. So what we have is volume assessed in two ways. One, this small number here actually shows you the number of contracts crossing per minute. And I love this number. I know that on the E-mini, I want to see 1,500 to 2,000 contracts at a minimum crossing every minute. And that's what this volume hammer traces out. This is telling you whether volume in a move is heading up, because you get a line here every minute. So this does not correlate. This is a minute assessment on a range chart. This could be a minute assessment on a tick. This could be a minute assessment on a 4-hour time chart. It's telling you how many contracts are crossing per minute, and what you want to see is as a move moves up, you want to see the volume hammer start rising. You want to see rising volume into a move, whether it's going up or going down. That's an independent variable and will help you enormously. Lastly, I'm just going to tell you, the MA Diff is the true assessment of overbought, oversold. Now, it has to be assessed on the 5 range. The MA Diff is a 13. And what that tells you is this. It tells you the space between the 15 and the 50. When this gets to be 13 ticks, and the MA Diff tells you, based upon 2 years of market replay data, if you take a long trade with a bigger MA Diff, the positive predictive value of the trade begins to diminish. It doesn't mean you can't do it. And I will take a trade at a consolidation trade. You can see the software gives you a consolidation entry right here. And the MA Diff is, I'll take a trade out of consolidation with an MA Diff of 15 or 16. But here's the true overbought, oversold parameter. And just to make it really clear, we have what's called the safe zone. And this line's always on the right edge. And this is always 13 ticks above or 13 ticks below the 50. And in this space is where you're going to get the trades with the highest positive predictive value. So every single parameter that you need to take a successful trade is right there. And boom. I mean, what we want to do is make the platform intuitive and easy to trade. I'm just going to go through one other thing real quickly. And to do this, I hate to take off. Let me just go back a ways here so I don't have any writing on the chart. I want to just show you our system-generated signals because they're awesome signals. But remember, they have to comport with market structure and price action, or you don't take them. Here's one. This is called a strategy entry. Remember I told you that if an entry is based on one time frame, it's of no value? Well, this has to comport. I'll click on it, you'll see the entry. It's a 5 range. Its analysis has to correlate with the 8 and 13 range to give you this entry long. Now, would you take this entry long? I would, because the 15's green, the 50's green. You don't have background bias, which you'd like, but remember that fractal analysis pushes every line we make to the right one candle. In real time, this was a triple green quant analysis here. One candle over. Now, we don't have order flow and momentum, and that is of concern. But there's too much going for this trade, and the strategy entry, because it signals at a great spot in terms of market structure and price action, you're in. Now, no system-generated signal with no quants, no background bias, nothing is going to make you money, which is why I said you have to learn how to read price action and market structure, and you have to look at, adapt to do a multi-time frame analysis. Well, let's take a look at another trade. And here's a trade out of consolidation. If you can't read it, it helps pinpoint it for you. And here you've got order flow, momentum, the intermediate quant, and the minor quant. It's a little bit, I wouldn't have taken the trade because the MA diff is so big and the market's so oversold. But if you're going to take a trade, that's 25 ticks with an MA diff. That's a big, way oversold. But it does make it because it's out of consolidation. Here's another strategy entry. Oh, here's a trade out of consolidation. That doesn't work. And believe me, I am not going to be anyone to sit here and tell you that you're going to get every trade a winner. Here's a wonderful trade that doesn't have the quants that I stood aside on. That's specificity. Sometimes you get great trades that you can't take. But that is the bottom line for day trading. You have to wait for everything to align. You're going to get winners that you just stand down on. And I would have stood down on this because I have no quants. I have order flow and I have momentum. That's tipping us off that the trade is, has a good probability. We have nice up bias. This is a strong up bias color. But I don't want to trade. This is just, for me, I don't want to trade without that first quant line. And actually, this first quant line may have been here, because if you push it over to the right one candle, you may have had an entry here. I don't want to manufacture them for you, but that could have been one candle. I believe it was. All the fractal indicators are pushed one candle to the right, and I could tell you why, but it would take me 10 minutes, but it's the way that NinjaTrader is coded. So this is an entry, and you get a great entry here that goes 6 points, depending on your ATM. We would have gotten knocked out of the trade, and I'm going to be honest with you, right here, on this big wick. Big wicks will take us out of a trade because we have a very conservative ATM. So here's another trade. Bottom line, without pushing it, is that I'm going to go to questions, is you find the trade first that works great with market structure and price action, and then you look for indicator confirmation. And I'll just give you one other word of warning. If you want to trade profitably, rarely take a trade when there's no background bias and there's no quant alignment. Because what is this telling you? I'm going to write it down. that there's no institutional participation. And why stick your neck out? Wait for the multi-time frame alignment of the markets, and wait for the quants, and wait for price action and market structure to give you a great entry. Twice this week, 2 out of 4 days, I was 3 and out. And we're up over $1,000 this week already, trading almost always 2 contracts. Occasionally I'll take a 4-contract trade, but I usually just trade 2 because a lot of people in the room have small accounts and I don't want to tax them out. And I could wind up having this number be 1,400. But my goal is not to run up a big number. It's to get a number that everyone in the room can get. So I took a couple of 4-contract trades on the E-mini because the E-mini is cheap. But most of the trades I take on crude, I take with 2 contracts. And this is just my teaching yesterday. Now, we have a reversal. We do have a counter-trend trade. I don't want to get into it, but it's the only one that works, and that was a 17-tick trade on 2 contracts. This one was a $360 winner on 4. I rarely take a 4-contract trade on the E-mini, but this set up too perfectly. I didn't even care that I didn't have the quant. Remember, that's just an indicator. I had order flow, I had momentum, I had market structure, I had price action, I had the 50 green, I had the 15 green, and off we were. And I just want to say one last thing, and then I'm going to go to questions, and then I'm going to take a question. Here's why algorithmic trading can be so successful. All these independent variables are related non-linearly. And that's a problem. That's why you need a lot of screen time. Because I'm trying to put this in a way that makes a lot of sense. And this is the way I think I can put it for you. And that is, every independent variable you use to trade with, and this includes market structure and price action, which are all unique independent variables, all have some kind of weighting, but they're all weighted in a nonlinear fashion. Now, so that they all have different weights in a given trade. Now, to me, the thing that has the most weight in every trade is price action and market structure. If you don't have that, you have nothing. But how do you weight whether or not a trade is going to break a pivot? It's very difficult. Some of them walk through it, and some of them bounce. Now, one way is to determine how many times the pivot's been hit in the past. And we look at that. But still, that's an assessment that's nonlinear. You can't make a good determination. Can you take a trade without your quant, without the correlative markets? Well, if you take this green line, and it would have been moved 1 candle to the left, trust me on that. I didn't close and reopen, you would have order flow and you would have had momentum. You have background bias. The blue is not the most powerful, but at least you're aligned. And you have some sense that institutional participation is present because you have order in this market. So even though, remember, the quants are not perfect. They're just an indicator. So in this particular case, I was able to let the quant lines go, let the correlative markets go, and they eventually swung in my direction. But by the time they did, and we'll move them over 1 to here, you would have had to enter the market here, and you can't enter here. You always have to enter on a retracement back to support or a pull up into resistance. And that's how you trade. And that's really why we make money almost every day. Not every day, but almost every day. And that's why this week we made over 400 on Monday. We made 200 on Tuesday. I only took one trade. I took 3 trades. I just made 200. It's all I could make. Yesterday I made about 135, and today I made 450. I'm not trading a lot of contracts. I'm not taking a lot of risk. I'm not running up a lot of commissions. And listen, I could take this with 10 contracts. These are small contract trades. And if you're trading a $5,000 account, you make $1,000 a week and make 20% per week, you're going to make a nice amount of money. So let me see if there are any questions. But no matter what system you trade, the takeaway from this is, really, is that what you want to do is you want to look at all the independent variables present on your trading chart. Don't look at any indicators that make an assessment of using price on your trading chart. They won't help you. Look at indicators that look into the future, and the future is the way your higher time frames are trading. Your price is going to swing into the direction of your 2 or 3 higher time frames. Order flow and momentum are very important parameters. If they're both green, even if you don't have the quants, they are powerful predictors of price movement, because this is a 3 time frame assessment, and we don't care what's happening on your trading chart. It's trading out of consolidation. That's an assessment. Market structure has to come off your trading chart. You can't trade price action or market structure off a higher time frame. That's insane. But indicator confirmation comes from your higher time frames or from other markets. And that's what's so powerful about the quants. And that's why I was able to pick the market apart on crude today, on the E-mini today. It wasn't easy today. But because I waited for my quant alignment, I was able to just yank 3 winners and 450 out of the E-mini like that. All I can tell you, just by seeing the falling channel into a downtrend, seeing my great background bias, and waiting for my correlative markets, and at the time, my volume hammer was going up. I was trading into rising volume. And when you see that, I'm telling you, you can back the truck up. So let me take a look at questions. Okay, there's a bunch. Hang on one second. Hold on one second. I'm so nearsighted, I got to take off my glasses. Hold on one second here. No, what we do is, on the 8 range, is I'll get to that question. Yeah, married to that. Thank you, Tommy. Yeah, listen, Pete. Pete wrote, there's a fib line whenever you need one. I'm telling you, please don't trade with fibs. Listen, John, we want the 50 and the 15 to be red on a short, and we want the 50 and the 15 to be green on a long. Those are independent predictors of a successful trade. But remember, you have so many independent variables to assess on a given trade. If you have 8 out of 9, and the one that you don't have is the 50 in the appropriate direction, you can let it go. Now, that's why we have the slope here. If the slope is like 0.1 or 0.2, you know it's really close to becoming yellow. And what is the slope of the 50 telling you? It's giving you the momentum on the higher time frames. So if the 50 is fairly flat, or if it's rolling, it's not really, it shouldn't censor a trade. And that's why you need screen time. But if you have the 50 heading down hard, it's crossed, you have background bias, you have the quants, you have order flow, you have momentum. If the 50 hasn't quite rolled yet, as long as it's not going like this, you could take the trade. The size of the range bar that we use is based on the average true range of the market. And we spent a lot of time optimizing what we felt was the best range candle to use. And the reason I like range is because I believe, remember, range only has one independent variable, price movement. What does a tick candle have? Two, price movement and volume. What does time have? Price movement, volume, and time. Three independent variables stuck into one candle. What I wanted was a candle that has one independent variable, and that simply is the movement in price of the financial instrument. This is time independent. This is contract number independent. And that's why I like it the best. This system works with time great. It works with tick great, but I like range the best because it boils everything down to a single independent variable. Remember, market structure on our trading chart is key, and in this case, market structure is defined by a candle that has only one independent variable, and that is the movement of price. It is time independent, and it is volume independent. And that's why I like range the most. And I think the range chart is going to give you, I think, your entries with the greatest positive predictive value. Now, some people are really wed to tick and time, and you can trade them. I don't want to be dogmatic about it and say if you do, you're a dummy or you can't trade successfully. The key is everything else. I think this is the best to trade, but that's not fixed in stone. In terms of the size of the range bar, again, we looked at the average true range of the market. Volatility on crude gives us an 8 range. If you make it bigger, then you're going to lose a lot of moves. If you make it smaller, you're going to get caught into a move that's chop. Same thing with the E-mini. If you make the E-mini, and you can trade an 8 range, but then you have to make your stop and your targets bigger, and you're going to miss entries. And if you go smaller than a 5 to a 3, you're going to have the same problem. You may get caught in a choppy trade, and I'll show you what we do trade 3. We traded on bonds. Bonds have awesome quants. The 2 quants are great. Bonds are worth $32.25 a tick. So when you take a trade on bonds, you better have everything, better have your ducks in a row, or you are going to look at a monstrous loser. You can't trade bonds into upside resistance, into downside support. You got to have a perfect trade, and you don't want to trade bonds when you don't have background bias and you don't have dual quants. But that, based on the average true range of bonds, that's when we have that as a 3 range. And you can get great bond trades, but you got to wait for everything to align. I mean, taking a bond loss will make you break out into a cold sweat. Yes, we'll send out a recorded link. No problem there. We're going to record it. Tom, I'm not sure what you mean by should support stocks going down, but I'll tell you, on this system, at one point, I was trading the Forex starting at 5 o'clock in the morning. I traded 12 Forex pairs because we have another piece of software called the dashboard, and the dashboard monitors every independent variable on a chart without looking at it. And when what I would do is I'd fold up every chart, wait for the alert, which meant the bias, the quants, the 15 and the 50 were all in alignment. The alert would go off. I'd pop the chart open, and that would be the Forex pair that I would look at. And I traded them really successfully, but I was getting too tired. I mean, I can't trade the futures market from 8:30 in the morning until we cash out, hopefully. and get up to trade the Forex market so early in the morning. But the Forex markets were very successful. 12 Forex pairs will wind up with an alert and give you great entries. And you can trade the futures market like that if you want to, or if you can make you can make all the money you need off of focusing on 2 instruments. If you want to trade more, you can. And we have algorithmic systems that trade all of them. But on a discretionary basis, 2 is all I can deal with. We're on Eastern time zone, Paul. Sure, I think I did that, Sam. Overbought, oversold is based on the MA diff. Right here. If you want it to be 13 on a 5 range, you want it to be 18 or less on an 8 range, and you want it to be 8 or less on a 3 range. Now remember again, I just want to repeat, all this does is decrease the positive predictive value of your trade. When you take an entry, you're able to make, based on all the independent variables on the chart, a risk assessment. And that goes to sensitivity, specificity, and positive predictive value. You eventually learn all of these independent variables. You get a great feel for what you need and what you can kind of let pass if it's not perfect. Trading a yellow modified 15 is another time when risk is higher. But there's certain times when all the quants are aligned, order flow and momentum are aligned. You get a great trade out of consolidation where you will allow that to go. That's the nonlinear relationship between these independent variables. You can trade an MA diff that's over 13 on the E-mini, but it's got to be an awfully good entry with all the other independent variables aligned, because you know before you take the trade that you're assuming a greater amount of risk. And what I would recommend you do, let's say you're normally trading 4 contracts, you're trading 6 contracts, dial the number back. Take the trade, knowing that you have a slightly increased risk associated with it, and instead of taking a 6 contract trade or a 4, take it with 2. In my ATM, I have the option of taking trades with 2 or 4. If I think the trade is perfect, I go with 4. If I think the trade is so good I can't pass it up, but isn't perfect, I take it with 2. I don't care. And after the fact, I don't care if it runs 172 ticks. All you can do is make a risk assessment on entry. You cannot determine how far it's going to run. And sometimes the trades in which the risk assessment based on their independent variables is a little higher, they go the furthest. But it doesn't make any difference. You can't cry over those, because that's what's going to make you profitable. In the long run, the higher risk trades are going to win a slightly smaller percentage of the time. So put less money up on those. Balance the increased risk on the trade with less risk financial-wise. And when you get a perfect trade on the E-mini, go with 6. And 6 is going to make you $300 or $400 easy on a trade that runs. Dave, we don't optimize for 5 range. What we did was we took all the independent variables and we made the assessment that 5 range is optimal to trade. We have people that trade the E-mini on a 4 range. All the signals will fire exactly the same way. We would have, and here's the thing about our system. It defaults to the nearest fib. So if you trade a 4 range, it's going to still take your higher time frames. Remember, it doesn't care what's going on here anyway. It's going to default your highest time frame. The bias, the quants are all going to look at this as a 5, but you may be able to get an entry a little bit quicker. Just remember, you may get stuck you may have a little bit more likelihood to get caught in chop. So you may get an earlier entry, but you also may get caught in chop. That's why we like the 5. But you can trade a 4 and the system will work fine, because every indicator assesses what you're doing on the chart, and if there's an input, like there's no input on the quant analysis, because the quants look up here. If you're trading time, they adjust. If you're trading tick, they adjust. So it doesn't make any difference. Here, all you're going to do is default to the closest fib, and the closest fib is going to be 21 anyway. So it's not going to change the input at all. So it's really cake to trade a 4. That's all. If you trade a 3, then we have to change the inputs, because that's a fib number, and we have to drop the time frames down on all the multi-time frame assessment indicators, which are all of them. But it's simple. I have a library of templates because we have people trading 4 hours, 8 hours, dailies. I just got asked for 1 minute, a 1 minute template on 5 instruments, bonds, notes. So we have people trading all different time frames. So we've got all that stuff. It's really up to you. And I'm telling you, I don't think that that's very important. You just be careful about chop. That's all. But if you adhere to the general basic methodology, you're going to do fine. The fib number, listen, fibs do describe some things in nature. They won't help you trade. But when you're trading a range chart, how do you determine what's the higher time frame? Remember, there's no time and there's no volume. So what we found works really well is the higher time frame for a 5 range is the 8, which is the next fib number. The higher time frame after that is the 13, and the higher time frame after that is the 21. So that seems to work extremely well, and we have not found numbers that work better on range. For time, it's just going to be 3 times. If you're 1 minute, it's 3 minutes, 9 minutes, 27 minutes. If you're tick, it's your higher fibs. If you're trading I don't have the fibs memorized that high, but if you're trading a 144, I think that's a fib number. It's going to go, it might be 256, and then whatever 3, it's going to default to the higher fib numbers automatically. All you have to do is put 1 tick value in, and the indicators do all the assessment for you. So it's really, really easy. And I make the templates for you. Like if you want to change this to a fib, I will create a fib template for you. I'm sorry, I will create a template for you based on the tick number. I'll create a template for you based on time. I don't really think that that's the key. I happen to like range. I told you why. It's got one independent variable, and that is price. If you want to trade a tick or you want to trade a time chart, I will not fault you for that, because a lot of people do in our system, and they do very well. I just happen to like this. This is my preference. But the system works great. It will not work on standard Renko. The standard Renko doesn't have open, high, low, close, and these indicators use them. It's not an oscillator, but it requires those 4 parameters on any given input, and we're never going to work on Renko. And I would ask you not to trade Renko, because Renko obliterates market structure. You can't trade channels. You can't trade retracements. You can't trade consolidation, because they're just bricks. And they're used to obliterate market structure. That's the purpose of them. But you can't trade with that price action market structure. And I think Renko is just kind of an easy way out for people, and it looks awfully great. I mean, when you see a big move on a Renko chart, it looks like you can make 100 ticks. But I'm telling you, I don't think you're going to make money with a Renko chart. But that's just my opinion based upon what I know of market structure and price action and all the independent variables we've developed. So let me just show you. We have a nice I'm going to put it up for you right here. If you like our system, and we'll give you a really nice special on it. And just go down to the bottom. And you know, it's very rare that I can guarantee you're going to make money. But I can tell you this, I don't know of a better system to trade. I make money in the room almost every day. And there's no, I mean, these are just trades. I don't need to show you these. Anybody can show you these JPEGs and show you successful trades. The worst system can cherry pick. And so I'm not even going to bother to show you these trades. This is our NTD. This is a patent pending system. And this is the way we enter an order. We buy an up close, we sell a down close. Whoops, where'd it go? And it's an awesome tool for trading. We never take a trade intra-candle. To me, it's like trying to understand what somebody is saying in the middle of a sentence. You got to let them finish the sentence. And when the market, if you respect price action, has to finish its expression, its sentence, the close of the candle shows you the size of the candle body and the size of the wick. It tells you the buying and selling conviction. We can buy at an up close, and we can sell at a down close, and we can significantly limit our losses. If we're taking a long trade, we can close on a down close. So if the trade goes against us, it goes 3 or 4 ticks up, and then we close on a reversal candle, we've just cut our losses by 50%. And that's what the NTD does. The patent's been pending for almost 2 years. It's under review now. I'm pretty sure we're going to get it because there's none like it. And it used to have a ladder, just like the Superdome did. But but NinjaTrader called us up and told us if we didn't cut the ladder off, they were going to kick us out of NinjaTrader and also sue us for patent infringement. So we had to cut the ladder off of it. But we're going to give this out. The indicator suite is normally $3,000. We're giving it for $249, and we'll put you in the room for a month. We'll give you the NDT for a month for free. That expires on Sunday. But our early bird is the same price for the indicator suite, $24.99. But you get 3 months in the trading room, 3 months with the NDT. I do a weekly didactic session, which is really like trading school. And I'm going to go through the Wednesday, I record them and I put them on closed links and I send them out to everybody in the trading room. And over the course of 12 weeks, you're going to get trading school like you've never had before. We start with price action. We learn how to read it. We add market structure. We learn how to read it. Then we add indicator analysis. And it's basically, I'm telling you, we charge $999 if you're in the room. We charge $5,000 if you just want to do it without that. And we also give you access to our proprietary video tutorial library, which is really excellent. I mean, I go through each indicator on video, each entry on video, and I teach a lot of price action and market structure. And I'll tell you, you can't find that stuff in books. It's just not around. So you get all that stuff added on for the $24.99. So listen, I hope you'll join us because I know I can make you money. And I do almost every day. And we rarely take much of a drawdown. We had a drawdown for a while on Wednesday, and I traded out of it, and we wound up making money. Oh, and our number is right here. It's 855-765-6681. And the point, I guess the point I'm trying to make is that everything we do is based on science, not on supposition. We've discarded what we think doesn't work, and what we have added in the platform I know works. And trading the E-mini with the triple quants and order flow and multi-time frame assessment of order flow and momentum is really a joy. The likelihood of follow-through to a first and second targets are very high. You just have to wait, and you have to have patience. You have to understand that you only need, I tell everyone in the room, 2 perfect trades every day, and we will make at least $1,000 in the room. The key is don't take losers, and that's what I try. I get anaphylactic shock, and my belly aches when I take a losing trade. I really do. I get visceral pain because I feel like they can be avoided if you trade appropriately. because the market is screaming out to you when to get in. You just have to hear it. So I really hope that everybody, let me see. Thank you so much, Sam. Listen, Sam, any information I can impart to you is just really, is great. And I thank you. I really appreciate it. So that's our system. I hope you'll join us because I think we can make you money. And if you've been spinning your wheels and trading all this stuff that's out there for a long time and you're not getting anywhere, if you've busted your account, you won't bust it on this system. And I will work with you. And I'm always here. Our tech support's incredibly good because we have a highly technical program. Sometimes it doesn't download perfectly. We have Sergio who's here. We have Oscar who's here. Awesome tech support, and I will answer any trading questions you have anytime. I'm here 12 hours a day. So have a really great evening. And no matter what you do, I wish you the best of luck. I know I respect your effort. And let me just tell you one more thing. Everybody tells you that in psychiatry, an obsession is a bad thing, but an obsession with day trading is a good thing. You have to be obsessed with it. You have to really put 100% into it. You have to spend time at night looking at the markets. You have to do your work looking at your charts in the evening time. And if you do, you're going to wind up with a great career. Well, all you have to do is wake up in the morning, sit in front of your computer without any hassle with employees or a boss, and you can make $50,000 a year on a very small account. And I'm telling you, when you make money, you're going to increase your contract size, and you'll make more. So look, again, I wish you all the best. You are the guys. You are the small commercial traders that need to be taking money from the other commercial traders. Don't let them take your money. Take care. Have a great evening, and I wish you all the best of health and wealth. Have a great, great evening. Bye-bye.